All right, let's get started with the first conversation today. I mentioned it had to do with passive investing, and the acceptance for passive investing is growing and has been growing over the past several years. In fact, you're probably already aware of conversations that we've had on this very program about index funds and ETFs. Now, those index funds and ETFs usually track the benchmark indices, that is the Nifty 50 and the Sensex index of 30 stocks. There are also some that track the broader market indices. But there is also a strategy that is in play that allows you to change the definition of index investing, of passive investing. That strategy is called smart beta. My next guest will tell you all about it and how you should consider adding this to your portfolio. Prableen Bajpai, the founder of FinFix. Thank you so much for taking the time, Prableen. I want to start with the most basic question. What is smart beta? What are these funds and how are they different from the traditional passive investing options available?
Hi, Alex. Good evening. And though I'm not able to see, but I think that you're in a very interesting setting, as you mentioned. Okay, I'll start with the answer to your question that what is smart beta? So, Alex, of course, just the way you've mentioned that passive investing or simple investing, basically where there is an index and a fund is replicating that index, has gained popularity. And then on the other extreme, we have the active funds where a fund manager picks his the stock holdings of his choice based on a certain strategy. And I think it's the marriage between the two where we see these smart beta strategies. So typically all index funds, let's say out of the 70, 80 large cap funds in India, currently about 40 odd are the active funds and about 38, 39 are index funds. And out of those, majority are the traditional market cap based indices, wherein Nifty 50, Nifty Next 50, Sensex 30, you mentioned these indices. These are market cap based, wherein a company as it grows in its size, the larger the weight it's given in the index. Now, this is the difference which smart beta investing brings in. That they bring in variations, they bring in some factors on the basis of which the index is constructed. And these can be volatility. The aim can be reduction in volatility. It can be momentum based, catching stocks, which are moving faster than the broader markets. It can be related to alpha generation and as well as quality, wherein you're selecting companies which have a very credible and sustained track record in the past. So smart beta is nothing but a variation of passive investing, wherein the indices are created in a different way. So instead of a fund manager offering a different strategy, the index itself offers a different strategy. So it's passive investing. The scheme just has to replicate that particular index. And Nifty currently has about 31 variations actually of these smart strategies, out of which there are approximately 6 to 7 schemes which we have, which are replicating these 6 broader popular smart beta strategies which are there currently for investors to invest in.
So let's do one thing, Prableen. Let's talk about these key categories that you're speaking about. And if I were to describe what you were saying in terms of market capitalization and the traditional index funds, one would say that a Reliance Industries and a TCS would account for close to what, 26, 27, close to 30% in fact of an index in terms of market capitalization. So in an illustration where you're putting 100 rupees, for example, in an index fund, 30 of those rupees would effectively be going towards these 2 stocks alone. Let's talk about the first one. You've identified Nifty 50 equal weight. How is this different?
So this first index, I think it's the simplest strategy of a strategy index. And Alex, just the way you mentioned, if you're looking at Nifty 50, the regular Nifty 50, we'll see that Reliance Industries, HDFC and Infosys, cumulatively, they'll take away almost 30% of the allocation. And this is where Nifty 50 equal weight, brings in the difference, irrespective of the market cap of that company. How big is the company in its size? It's going to give a 2% allocation to all these 50 stocks which are composite in the parent Nifty 50. So the composition remains the same. All the Nifty 50 stocks are there, but the weightage which is given to them is similar, which is a 2% allocation each. So my allocation to Nestle, my allocation to Coal India will be equivalent to my allocation to Reliance Industries in this particular index. And it's interesting because this way your concentration to these particular bigger companies actually goes down. And there are three funds currently which investors can look at to invest in this particular index. It is the DSP, HDFC, and Aditya Birla. These three fund houses are offering a Nifty 50 equal weighted strategy. And Alex, here, one thing is interesting because this particular index, because it's just giving a 2% weightage to each of these 50 stocks which are there in Nifty 50, it's a combination of growth and value, wherein you will sell a company which is exceeding the 2% allocation, and then you buy a company which is lesser than the 2% allocation. However, there can be chances of the particular index underperforming as well if the markets are very polarized, as in only 3 or 4 bigger companies are pulling the markets up. So that's the first strategy.
Absolutely. And in fact, that was the case for a while. And then you saw such a broad-based gain pan out over the course of the last year or so, right? I think the next option is an extension of the first, in that it's the Nifty 100 equal weight index, right, Prableen?
Same thing, Alex. And what you mentioned, that now it is broad-based, and earlier it was the polarization. I'll just give you figures for the last 1 year. Nifty 50 equal weighted actually gave a 74% returns as compared to Nifty 50, the regular market cap based index, because now we are seeing a broad-based rally, and it wasn't the case earlier. In fact, even year-to-date returns for the Nifty equal weighted are more. Likewise, Nifty 100 equal is nothing but a 1% allocation to the top 100 stocks. And Alex, we know that these top 100 stocks are nothing but the large cap space in India. So if you're investing in this particular index, you're actually covering all the large cap stocks which are out there with a 1% allocation to each. Though I would personally say that here, investors must understand that there is somewhere too much of diversification, because a 1% allocation I feel becomes too minuscule. Though the fund has performed well, it has given about 68% returns in the last 1 year, because we've seen the large caps, of course, run up a lot. And it's a good combination if you're looking at Nifty 50 and Nifty Next 50. So it's a compilation of both, but in equal weightage, 1% allocation. So a sector like financial services is just about 23% vis-a-vis what we would see in, let's say, Nifty 50, the pure Nifty 50, where it is about 37%. There's a fund from Principal, Alex, which is giving exposure to this particular index.
Understood. There's also now the next one that has been highlighted, which is the Nifty 100 Quality 30 Index.
Yes.
How does this work? You mentioned the whole idea of quality, but how do you explain this?
This one is interesting because they are looking at companies which have had a very, very sound track record in the past, and it's based on low gearing, as in the debt on the company is less, it's got high return on equity, and it's given a very sustained growth profit as well. So on the basis of the five years of performance, Alex, this particular index is constructed. So I think it's a very interesting combination. But here, when we're looking at quality, this particular index has been able to, maintain, or let's say hold on to its returns during downtimes as well. It's fallen less than the broader markets. But whenever we are looking at an index which has fallen less than the broader markets, even during the upward journey, the returns can be slightly lesser than the broader index. And the allocation to each of the companies in this particular index is capped at around 5%. And here, Alex, consumer durables, because these are companies which are there throughout, let's say, during different cycles also they perform. IT, these are the bigger sectors here. So consumer durables, IT, and financial services actually are taking up almost 70 to 80% of the allocation in this particular stock. There's a fund from Edelweiss, which is offering exposure to this particular index. It was an ETF. Now they've offered the index fund as well. So somebody who doesn't have an demat account can also invest now. And it's got a lesser beta as compared to Nifty 50. It is about 0.7. So it's an interesting strategy. Somebody who's looking for a slightly conservative approach to holding companies.
So the next one, I think, relates to something that a lot of people are in search of. Prableen, with the Sensex with the Nifty holding above 18,000, we're talking about value, right? So how does the Nifty 50 Value 20 index work?
Value 20, it's a very concentrated portfolio, Alex, because it's just a compilation of 20 companies from this basket. So they've filtered these 20 companies from the whole Nifty 50 basket of 50 companies. And it's based on, again, variables like price to book value, price to earnings, and dividend yield, and how liquid these companies are. TCS has about 15% allocation. Infosys also has about 15%. HUL has about 10%. So it's a concentrated bet. So any investor who's looking at a value approach can look at this. But again, the capping for a particular stock in this index is at 15%. So your allocation is quite more than the usual. Otherwise, in a regular mutual fund, it's usually around 10%, what we see the capping as per rules. So here, there will be little more let's say focused kind of an approach and little more concentration. IT and consumer durables and construction are the top sectors here. But again, Alex, it has performed very well. And the returns for the last 1 year are again about 67%. And over a 5-year basis, it has given 22% returns as compared to 16% for Nifty 50. So it's totally, it's given returns by about 6% more than Nifty 50, I think, which is quite high. And beta with Nifty 50 is about 0.75.
Understood. It is, though, like you mentioned, a more concentrated portfolio of stocks that you look at, right? But let's talk about the last one that you've highlighted, or rather the second last one that you've highlighted, which is the Nifty 200 Momentum 30 Index. How does this work?
Momentum investing as it is quite in. I think a lot of PMS are run on it, and a lot of investors are looking at this kind of an approach. There's a fund by UTI which is tracking this particular index. Now the criteria, Alex, for selection of stocks is that Nifty 200 gives you large cap allocations as well, a little bit of mid cap stocks as well. So it's like the momentum score that the index creates based on how each stock has performed in the recent 6 months and 12 years, the price returns, and it is adjusted for volatility. So based on that, this particular index is created. And then there's this fund by UTI, which is tracking it. Here we are seeing, stocks like metal is the highest sector allocation, followed by IT. And then we have financial services. So companies like Hindalco, Bajaj Finance are the top picks, but it's got about 5% allocation in each. And it has performed quite well in the last 1 year. It's again given about 65% returns, and over a 5-year period, it has given 23% returns. So that's quite good as well. And that's the highest among all these strategy indices, Alex. The momentum index has actually given the highest returns over a 5-year period. But again, it's not for everybody because there will be volatility. So somebody who has a high risk profile, I think it's more suited for them.
And the last one, Prableen, relates to people without that kind of appetite, I would think, because you're talking about a Nifty 100 low volatility 30 index.
Yes.
So like the name suggests, would you suggest that that has something to do with someone who does not want to take too much risk, too much volatility?
Yeah, absolutely, Alex, because this one, out of the Nifty 100, the top, it's a large cap fund again. So out of the 100 stocks which are there, it's selecting these 50. And again, these are selected on the basis of the volatility values which are given, which is on the basis of how much standard deviation has been there on a daily basis. So volatility for the securities is basically calculated as the standard deviation of the price returns for the last 1 year. And on that criteria, the index is created. So again, consumer durables, more defensive kind of themes will be present here. Consumer durables, again, IT, finance, and companies like Dabur, Britannia, Hindustan Unilever, Nestle, HDFC Life. These are the top picks in this particular index. And again, it has a low correlation with the broader market, which is Nifty 50. It's about 0.68. So among these different strategies, this one is not offered as an index fund. It's offered as an ETF, Alex, by ICICI. So this one can be seen. But again, as I mentioned, ultimately for any investor, it is very important to see his or her overall portfolio, and then based on that, select any of these strategies, because ultimately is exposing them to equities, and a majority of them are in the large cap space.
So, which brings me to the last question, Prableen, and this has to do with strategy. We've broken down,
Right.
or rather you've broken down so nicely for us, the various options available for smart beta, right? But how does this fit into the overall strategy? Do you still use one or a combination of two of these when you're constructing the core of your equity portfolio, or do you use this in conjunction with the traditional index funds?
I feel, Alex, in India, we are at a place where there is scope for active and passive investing together in our portfolios. But all of these strategies which are currently available, I think these can be a substitute for a large cap fund in the portfolio of an investor. So if somebody has the appetite and is looking for a particular strategy, so instead of going for a typical regular Nifty 50 index, they can go in for these variations. But again, the decision has to be based on what is their own risk appetite, what is the time horizon, and what are the other stocks or what are the other schemes actually in their portfolio. Because I think the decision can never be in isolation. But yes, I think all of these strategies definitely have the potential to be a part of the core portfolio for investors, other than maybe momentum, because it would be slightly higher risk, broadly depending on the risk return profile. But yes, they can fit into the core as well. But a very small allocation won't make sense, and too much again with another passive fund won't make sense, because the correlation between these is not very low. So between some of these strategies, it is at 0.6, 0.7, but seen, when we are seeing an isolation point, more than 0.5 is not really low correlation as such. So I think the decision has to be made depending on the overall portfolio for an investor. But these strategies are interesting, and the expense ratios can be slightly higher, Alex, here as compared to the traditional passive funds.
Prableen, thank you so much for joining in and for breaking this down for our viewers. And by the way, you mentioned the settings. So what I'm going to do is I'm going to take a list of the movies that are available, and hopefully
wow.
I'll catch a couple over the weekend. I'll send you a few recommendations while I'm at it.
Thank you. Thank you, Alex.
Thank you so much
Pleasure
for
being
taking the time.
Thank you.